Good morning, everyone. Today, our session number 8, day number 8, dated May 17, 2026, part number 18. So far, we already covered 7 sessions in which we covered the major fundamental principle understanding of the corporate tax. And today, our same webinar is live on the YouTube also. If you want to join from the YouTube, so you can join from there also. If you face any difficulty, that is also live. Apart from that, during the session, any question answer, you can chat from YouTube also and from Zoom also, as previously we used to do. Today, our topic, again, as a continuity, we can take the recap, quick recap. So we discussed the UE corporate tax. In terms of the UE corporate tax, the principally what we understand. Then we said, okay, we have to understand who will pay and what will be taxed, means which income will be taxed. Today, what I did, I added over here the taxable income. I added over taxable income, this one. Just for our understanding as improvement. So this is the same we are discussing over past few sessions. Why is that we are discussing in past few sessions? Let me make the full screen. So we are discussing the taxable income, which means what is tax. We understand we start from the accounting profit. We start from accounting profit. And then we start towards the computation. We start the computation toward the taxable income. What is the taxable income? On that income will be, we will pay tax. The income on which we will pay tax. So this is the income we have to pay. Our starting point is this. We are covered the almost two adjustments. That is the one of eighth adjustment as the allowed and disallowed. Second, we discuss the exempt income. Now the third is the intra-group transaction. Intra-group transaction. So when we opt for the tax group, and in which, of course, tax group will be treated a single or taxable person in front of the FTA or in taxable front of taxable authorities. So of course, when we come as a single unit and a single taxable person, so between the sale and buying and selling between the intra-group will be eliminated. So this will be our first point today we're going to discuss. Then the second point we're going to cover transaction with related party and the connected person. This is also very common in most of the organization. This is there. Even related party is not there. Connected person will be there. So connected person will be the owner up to fourth degree relationship. The people's circle that also fall over there. Then the fifth adjustment we're gonna discuss today, that is the unrealized gain and losses if election is made. So this is one of the common election that most of the organization they are opting that, and this is the should be opt in the first tax return. This is the one of the election that is mandatory and irrevocable that we have to opt during the first tax return. So these 3 points we're gonna cover in the part number 18. Of course, we're gonna continue the session thereafter. So let's jump and see without wasting the time. So what is the exempt income we already covered. So this is, I mentioned that exempt income. So we already covered this one. Here, just quick overview, how many, what are the total 8 adjustment. So the sequence is not the in the same way. So the fifth adjustment today we're gonna cover. So this is not yet covered. Third adjustment, again, today we're gonna cover. This is we already covered. So these two we already covered. This one, intra-group income arising from the intra-group, and the point fifth unrealized today we'll cover. So up to the 3, 4, and 5 today is the hour covered in this topic. So just for the understanding, what are the next three adjustment we can see here. So that three adjustment is transfer of losses within the group article. The losses is another critical and important point and interesting point, the loss relief. Then the incentive tax relief. Then the eighth point is the any other adjustment. So these are the total eight adjustment, and so far we covered first and the second, and today we're gonna cover this, and this. So if any question so far, if you have any question belongs to these eight adjustments, so please let me know. Most welcome for this adjustment. Okay, so let's, yeah, I have to continue with the same. So these adjustments, just quickly overview, we taken that. So now let's start with the adjustments, third out of eight, income arising from the intra-group transfer. Now, first we have to understand what is the income. The accounting income, we already discussed in the previous sessions, the accounting income, because we are starting from the accounting profit. We're starting from the accounting profit. Okay, our starting computation from the accounting profit. But let's say we have the entity A, B, C, and D. So here is the parent company. I'm just parent company, and normally they're called head office. So he have the shares here, 97% shareholding, 96%, 98%, and 99%. So if these are the four companies under the ownership of one parent company, so what is the FTA and the UAE tax law is saying, as per the law, we have the option to make the tax group. So now the tax group is not some kind of mandatory, this is the optional. Okay, but if we choose this to go for the tax group, so what will be the advantage? What will be the disadvantage? That of course we're going to cover in detail also. But first let's understand what is this intra-group transaction elimination. Because when we talk about the taxable income, so we have to understand what are the possible adjustment is applicable based on the facts and figure according to scenario and according to the group structure. So here one of the requirement, if we have direct or indirect shareholding 95%, so then we are eligible for the tax group. I'm gonna use the TG as a tax group. Okay, if we are eligible, what does that mean? By default, we are the tax group. The next question is coming, even we eligible, so this is the by default will be a tax group. No, by default we cannot be a tax group. So what we did, we are eligible, but by application. By application. How we'll proceed with the application? Once we come in this topic text group, that of course it will take 4 to 5 hours topic. We will see from the FTA portal also how to apply for TG. This is a quick understanding from the each entity. They will apply from their FTA login. From their FTA login, submit the application under the parent TRN. Parent TRN. Okay. They will submit application to TG under. So once the application will be initiated from here, once the application initiated from here to here, They have to approve. First, they are opting, this is the head office as the parent group, the parent company as a representative, because of course they have to appoint the representative. They're saying, okay, we're going to apply the tax group under this, and we are opting the one of the entity that this is as the representative. Then again, this company also do the same exercise. This same exercise, same exercise. Okay, this is the first process is completed. They are applied. Now the tax group will submit the application to the FTA to form the tax group. Then of course, the one of the criteria is to check this 95% more, 95% more, 95% more. Now, if we are talking about this in simple way, this is the UE companies. We are assuming that all of the UE resident companies. So this is one of the another criteria. You can make the tax group with the UE resident companies. So in this way. So up to here, any point, any question? So let me know, please. So this is the group tax group we understand. Now we understanding if this company, if this company sell to this and this company buy from here, okay, of course, maybe this company selling to them, maybe this company selling to here also. So which means at each point, they will record the cost at each point of transaction, because when we make sale, so what we have, we recorded the cost, we recorded the sale, which means the profit is recorded. So all these points, here also the same thing happen, here is also same thing happen, here is. So when we are as a one unit, so these profit will not be remain there. These profit at the each point, as we understand, the profit will be recorded. Profit will be recorded because of course they are selling at the certain margin. To eliminate these transactions, so what they sent, income arising from the intra-group transaction, and if applied tax group, then income arising. So what we have to do? In that case, we have to cancel this transaction. We have to eliminate the transaction. The word is used over here, the exclude or remove intra-group. What they think, just go back and see whatever the transaction is here between the intra-group, reverse that, eliminate that. So of course, the eliminate will not be happen in the books of the original company. Okay, the A. This is another, see, we are not discussing only the tax regulation. We are also learning that the practical implication and how we can do in our books, because this is what we seen what during our learning also, this question was coming. Okay, because even most of the training institutes, what they say, okay, this is the law is saying. The question is coming from the participant, from the students. They're saying, okay, what we will do? Okay, you told, okay, do this. How to do this? Okay, that is not their scope to give you the practical understanding, practical environment, how it will be affected. So originally, accounting books will remain same. It will remain same, remain same. Why? Because the accounting team, the first priority, accounting team, first priority to record the transaction, what is actually happen. Because they have to adjust the inventory. Because the inventory from one organization to another organization, So here inventory will be minus, here the inventory will be plus, the second organization. Accounting team have to do this transaction in the accounting system. And even what we are discussing here as the eliminate or adjust and remove, this is not the original books of accounts. Original doesn't mean you are making two books of accounts. Here the word is used the tax group. So tax group, you can make these separate, I'm going to use the word of the separate accounting system for this. Accounting, let's say you are using the Zoho. Zoho one of the accounting software or Odoo one of the accounting software or any other SAP Oracle. So let's take the example of the uh, Odoo or the Zoho you are using the accounting. So here you already have one organization here, one here, one here. Take another fifth organization. So once you have the trial balance or the from the each organization a profit and loss, I'm going to use the word the trial balance from the each organization TB plus TB plus this is the TB plus. So all this TB, if you add into the fifth organization as a practical understanding, this is not law what is saying, but ultimate to reach towards the law and the traceability. The word traceability, ISO 9001, is focusing on the traceability, is giving us the understanding and guideline of the traceability. Even the accounting standard also given the traceability, the importance. Why this is important, we will learn that. So if we record the 5 TB here under one organization, 1 TB, 2, 3, and 4. So when we add all the 4 TB, so then we will see, okay, now the 4 TB are there under one organization. This is the one organization that we call the tax group. Why I'm saying this is the for practical implication, how to handle, how to record, how to keep the record. The first you will receive all the TB. If we want to track back the original, if we track back to original TB up to here, we can track. If we want to track here, we can track. If we want to track here, we can track. If we want to track here, we can track. So then we have the all the TB and profit and loss. Then what will happen? If we added the 4 TB and here it will be single unit. The profitability, just cross check the profit from first, second, third total, all will be the same. After adding all that is, let's say, the 100 million, 20 million, 20 million, 20 million, and the 40 million. So it will remain the same. The first test, okay, the each TB and the accounting and the figures are correct and is recorded. Now, once it's recorded, I think let me make some space over here. Let me make one space over here. Any question, any important understanding that? So let's give the one another point. Okay, here we said that 20 million profit. Here we said another 20 million, here another 20 million, and here is a 40 million. So same way, now when moving the profit here under the tax group, and when we making the another tax group, so what we gonna do that? So we have to say, okay, this is the fifth under Zoho fifth entity. Under Zoho, this is the fifth entity. So we are saying we will bring all the profit from the individual books. A, how much the profit? 20 million. B, I'm just giving the profit means it will come all the complete TB. But as a reconciliation point of view, we are discussing the, so this is 20 million, this is the 40 million. So total will become 100 million. So the first point when bringing the books of accounts and the corporate tax, so it's already the in the, and this is what the fifth organization is, a tax group. So this is the tax group and everything is traceable. We recorded the transaction, and when we test that, everything is matching. Now the tax group is saying intra-group transaction, income arising from intra-group. Because you are one group, so whatever the profit coming from each intra-group transaction, we have to adjust or remove. So let's say we take the another example over here. If transaction happen A to B, here is a 5 million intra-group. Okay. So if a transaction happen here to here, this is the 2 million. If transaction happen here to here, this is the 3 million. If transaction happen to here, this is the 6 million. Okay. This is a common example we are taking. So which means I'm taking the intra-group profit, not the transaction. But originally, if even we talk about the transaction, let's say the transaction, the 50 million, of course, when one company is selling, other company will be buying, right? So A and B, they said, okay, let's take this example, sale and purchase. Let's take a comprehensive example. So A to B, how much they sell? A to B, how much they sales? So here we said the 5 million is a sale. So of course here will be the 5 million purchase also, where the purchase is here B. Just as a practical scenario, take this example. So now let's see the next transaction B to C is actually C to B. C made the sales of 2 million and C to B. So of course he have the purchase, another purchase 2 million. Then let's go to the D to B. D to B, how much? 3 million. Okay. So which means D made 3 million to whom? B. So again, he buy the 3 million. So if we take the total 5 plus 3 plus 2, if we take the total, so it's matching or not matching. So far, plus and minus. So one side purchases will be out, another side sale will be out. Okay. So from D to A, how much we made? 6 million. So here we are saying the D another 6, then to whom purchase is A. So the same amount of the sale and same amount of purchase will be eliminated. So how much it will be? 5. 5 plus 2 plus 3 is 10 plus 16. So here is also 16. And here is also 16. Another side is also 16. Right or no? So what the tax group guideline and the law implication, they're saying, close this, close this. So when you are recording here, the reversal of the transaction under this, the original transaction. Why? Because here we cannot make the original transaction reversal because that accounting transaction will remain same. But what we did, we made separate group company in which we added all the 4 organization, and then we are saying, okay, each transaction we are reversing. How the reversing? How the reversing? If sale, make the credit note or say, sorry, the sale reversal through the credit note. So sale and purchase both will be adjusted by each organization. The impact will be eliminated. So maybe after doing this, the profit figure will be 80 million. Any question here? Any question up to here? What will be the implication by submitting the subsidiary? Okay, so again, I'm just referring everything. I'm audible because Neelam question is she's mentioning I'm not. Just quickly, please confirm I'm audible. We submitted by subsidiaries. Yes, Sidra, the application I just given the each subsidiary will submit and the parent will be approving. Then further the tax group application to the FTA will be, and all this happen through the FTA portal under each company. So I believe up to this, the scenario and the complete topic is clear. So this is the intra-group adjustment. That is the importance and how to handle and how to manage with the practical. Of course, when which article is dealing? The group article 41 and 42 is dealing to make the adjustment. Any question, welcome.